positive on the stock market today, and actually for 2019, we have a moderately bullish outlook on the stock market at Matarin this year.
What about the risks that are out there? I mean, we had a debate at the top of the show today as to whether the bottom was in. You feel like it is?
Yeah, I saw it. Well, you know, actually, our market outlook did turn down at the beginning of last quarter, and it's recovered now. Actually, it's more positive than it had been. And there are a number of reasons for that. One is we've seen interest rates come down, which tends to be a positive for stocks. We've also seen that, which you also discussed, that bullish sentiment has really gone into decline. You've got a number of institutional investors not only saying that they're expecting a correction, but even talking about the possibility of a bear market. We actually see that earnings momentum in the intermediate term has remained pretty strong in the U.S. despite
You're not buying
Q4.
any of the most negative of forecasts. We've been in a bear market where recession's coming sooner than we think. All of these risks, Fed, trade fight with China is just going to be too much for the bulls to endure.
Well, it's those types of debates that create the opportunity. It's the debate that creates the opportunity for the investors who have the stomach to step in and get involved.
It's interesting that one of your picks, speaking of low vol, the S&P low vol ETF, is one that Josh Brown mentioned at the very top of the show. Why don't you tell us why you like it? And I'd love to have Josh engage on that as well.
Well, we are positive on the markets, but with volatility being what it has been, it may make sense if some investors are looking for more defensive stocks. And so when you look at the SPLV, the S&P 500 Low Volatility Index, last quarter, it actually beat the S&P 500 by about 8%. And it was one of the few indices that ended 2018 in positive territory. Nearly flat, but positive. And so it may be an interesting place to park your money if you want to be in the markets, but you're not ready to get completely aggressive. That said, investors should pay attention to some of the specific risks that come with many low volatility indices.
So let me ask you about that then, because when you look at high beta or you look at low volatility or, frankly, earnings growth or any of the factors that you could use to break the equity market cap link and do something else with an ETF, there are some specific issues. And in this case, I think a lot of the low beta portfolio, you're going to get basically rate-sensitive stocks. You're going to get utilities, you're going to get consumer staples. And so you're just you're not really taking the risk out. You're just taking on a different risk than what you would have with owning the S&P. You agree with that, I would assume.
Exactly. As a matter of fact, if you take a look at that S&P 500 low vol index, it's got a 15% higher weight in utilities and a 14% higher weight in real estate than the traditional benchmark.
Right. So you're betting on rates staying low, basically, or falling, as opposed to betting on rates rising with a different index. So people should just, I think your message is the right one, which is risk can't be eliminated, it can only be transformed.
And to mind your interest rate outlook. So we actually also think that interest rates are going to stay low in here, partially because of what the current markets are doing to the inflation environment and monetary policy. But if you think back to February of last year, do you remember the market went down by 10% in about 9 days from the end of January to the beginning of February last year? And at that time, it was because of a fear of rising interest rates. And so bond yields went up while the market was going down. And at that time, the low volatility indices were not able to protect capital in the way that investors might have expected. So
isn't it true, though, that the industry, the ETF industry, is finding ways to take out this kind of risk? If you say that low vol is going to overweight you in utilities and REITs, which it does, there are other ways. Goldman has one, iShares has one, where they say, look, let's go after quality, let's go after high cash flow, let's go after not over-concentrated sectoral plays, but we'll just mine for better quality stocks in the S&P. I like that. But I don't like strategies that overweight you in a sector, because when that sector turns, you get slaughtered.
But it's not, so that's the point, though. So they're trying to weight toward stocks that are less volatile in the market. The consequence of doing that type of weighting is that you end up with a big sector bet. So they're not saying let's own a lot of utilities.
But that's the whole play in active beta. That's the whole idea in rule-based.
So Goldman's version, they might say we're going to weight toward quality, and then guess what you end up with? A lot of financials. So it's like you almost can't escape having a sector over and underweight so long as you're constructing a portfolio based on any factor,
But
whether
we have
it's
to
momentum or
remember
quality or
that
otherwise.
even the S&P 500 has sector and industry biases and high vol and low vol
It's a tech bet
biases.
these
So
days.
it's really just a question of which ones do you want to take right now.